Welcome to Phillip Futures Market Watch. My name is Kheng Ann. I am the Business Development Manager for Commodities in the Futures Market. This week, I will discuss the outlook of the rubber futures market. First, let's take a look at the history of rubber in Singapore. Singapore has been the rubber trading hub since early 1900s. Ships bringing rubber from Southeast Asia countries like Indonesia, Malaysia and Thailand used to call at the Singapore port for sorting and re-export to Europe and East Asia. Since then, rubber has been a major contributor to the development of the Singapore economy. The Singapore River used to be a very busy river, which served as a key transportation channel for rubber trade. Most of the rubber traders has been making their fortune through rubber and has subsequently gone over to develop other sectors like the Singapore banking industry. Banks like OCBC, UOB, OUB all have their roots in the rubber trade. During the early 90s till 1994, trading was done through the Whispering market. It was further transformed into Singapore Commodity Exchange or SICOM to trade the rubber futures product using computers, and this results into greater transparency of the market. Future Trading Act was introduced in the rubber trade, and today SICOM is traded under SGX, and SICOM rubber prices are acknowledged benchmark for the global rubber trade. There are 5 rubber future exchanges in the world where investors can trade rubber: Singapore Exchange or SGX, Tokyo Commodity Exchange or TOCOM, Shanghai Future Exchange or SHEF, Agriculture Future Exchange of Thailand AFET, and the National Multi Commodity Exchange MMCE based in India. All of these 5 exchanges, TOCOM and SICOM, are popular with Phillip customers. There are 2 major contracts traded in TOCOM and SICOM. The TSR20 contract, or the Technical Specific Rubber, is a liquid contract which has allowed to be congealed naturally and reformed into blocks that can be used in its tire manufacturing. This contract is popular in SICOM as it provides market participants with a reliable pricing basis as a point of reference for their physical cargo and to manage price risk. This contract is widely used by regional and local producer, traders and consumer. The contract size for this contract is 1 lot is equivalent to 5 metric tons. Minimum price fluctuation is 0.1 US cent per kilo, equivalent to US $5. Electronic trading hours are between 7:55 AM to 6 PM. The other contract, RSS3 or the Reed Smooth Sheet contract, is a liquid latex rolled into sheets and put into a smoking process. This is a popular contract in TOCOM due to its liquidity and speculative nature. Trading hours are between 8 AM to 2:15 PM for the day session, and the night session is between 4:30 PM to 6 PM. The contract size is 1 lot equivalent to 5,000 kg, and its price movement is at 0.1 yen. In order to understand rubber prices and its trend, you need to know the fundamental. Let's take a look at the report by the Association of Natural Rubber Producing Countries. Total natural rubber produced by the Association of Natural Rubber Producing Countries has increased steadily over the years. In 2011, production was up by 8.1%. In 2012, production was up by 3.6%. And in 2013 was up by 4.7%. Hence, you can see every year there is an increase in production of natural rubber. Supply exceeds demand. However, the International Rubber Study Group, which forecasts supply and demand, expects supply to outstrip demand by 241,000 tons in 2014. This will put pressure on the rubber prices. Top producer Thailand, which usually see the production of rubber increase by 10% annually, may now only see production of rubber rise by 5% in 2014 due to the low rubber prices. The Thai government has encouraged the farmer to cut down on the rubber production and switch to crops like palm oil instead. As you can see from the chart here, from 2002 to 2011, rubber prices have steadily increased over this year, peaking in 2011. Since 2004, the increased production has risen to 13 million acres. As a result of this increased production, the oversupplies have contributed to the current low rubber prices. Tokyo rubber futures dropped to the weakest level in more than 4 years on concern over the high inventory and drop in demand in China. Global oversupplies have dragged on the benchmark contract, pushing down nearly 30% so far this year at TOCOM. The global market is also worried about the high stocks in China. This was further aggravated by funds and speculators selling. This has resulted to push rubber prices lower after prices failed to rally. On 15 July this year, all prices penetrated through the psychological support of SICOM 165, TOCOM at 200, and the Shanghai Future Exchange at 14,000 levels. Farmers will reduce tapping as earnings are not enough to cover the costs. With income for farmers falling, in Malaysia, the government has come in to help the farmer with a one-time payment of 500 ringgit. Whereas in Thailand, the military government will be encouraging farmers to cut down more rubber trees in a bid to restrict supply or as to help shore up prices. They aim to cut down 350,000 rubber trees a year. The government will be encouraging the farmers to switch to growing palm oil to help to meet the recent demand of the biofuel industry. We expect concern over the slowing Chinese economy to continue, especially when China experiencing economic slowdown could translate to slowing demand for rubber. Rubber prices will continue to be pressured as there is an oversupply at the moment. However, some support may stand from a strengthening US economy. On the whole, rubber market is still at the mercy of the states of the global economy and the poor demand outlook. It will probably last for another year or two until we see a change in the microeconomic performance of the global economy. The bull is likely to return in 2017 when the market feels the impacts of the low prices, with farmers cutting down rubber trees to switch to planting palm oil for better returns. Investors can choose either to trade in TOCOM or SICOM. However, TOCOM are traded in yen and SICOM are traded in USD. Investors can either go long, that is to buy, or to go short, that is to sell, depending on the view of the markets. As I have already explained on the basic fundamentals of today's current market situation, I could like to take a short position. However, it could be safer to go short on any rebound. Investors have to take note that the current rubber prices are already in the 4th year of decline and are expected to continue into 2017 until the current oversupply situation is corrected and the Chinese economy data improve significantly. We have come to the end of this week's edition of Market Watch, where we will have discussed the rubber futures market in TOCOM and SICOM. For further information on the risks and returns of investing in the futures markets, please approach any representative from Phillip Futures for the further discussions. With that, I have come to the end of the presentation. Please subscribe to us on PhillipCapital, YouTube and Facebook. Stay tuned for more Market Watch videos. Thank you.